Hey everyone, and welcome. Today we're diving into one of the most critical yet often confusing concepts in India's entire GST framework, the place of supply. Now this might sound a little technical, but getting this right is absolutely essential for any business operating in India.
So here's a question for you. Why is it that getting just one address wrong on an invoice, a simple clerical error, can end up costing a business real money? I mean, it can lead to paying the wrong tax, getting your funds completely blocked, and creating a mountain of paperwork. The answer to that question reveals just how high the stakes really are in the GST system.
And the answer is actually pretty simple at its core. It's because GST is what's known as a destination-based tax. All this means is that the tax revenue is supposed to go to the state where the goods or services are ultimately consumed, not the state where they were produced or sold from.
Now, this whole destination idea creates two completely different paths for your tax payment. If you sell something within the same state, let's say from Nasik to Pune, both in Maharashtra, that's an intrastate supply. You'll have to pay two taxes, Central GST or CGST and State GST, SGST. But the moment your sale crosses a state border, say from Nasik to Ahmedabad in Gujarat, it becomes an interstate supply. And that attracts a single, different tax, the Integrated GST or IGST.
And believe me, making a mistake between these two is a huge deal. As our source material points out, if you pay the wrong type of tax, you don't just get to fix the error. You actually have to pay the correct tax all over again, and then go through the whole process of claiming a refund for the wrong one. This means more paperwork, more hassle, and most importantly, your working capital gets tied up.
So, how do you know which tax to pay and avoid this whole mess? Well, the entire system really hinges on one single concept: figuring out the place of supply. The absolute best way to think about it is as the official GPS coordinate for your tax payment. It tells you exactly where that transaction's destination is.
Officially, the place of supply is just the location where goods or services are consumed. But here's the kicker. This one piece of information is the trigger that decides whether a transaction is intrastate or interstate, and that, in turn, determines which government's treasury the tax money flows into. So getting this right every single time is not just important, it's everything.
All right, so how do we actually find this place of supply? Well, the rules are different for goods and for services. Let's start with tangible goods, which are usually more straightforward because, you can physically track them.
For goods, the rules generally fall into three common-sense scenarios. First, when the goods physically move from the seller to the buyer. Second, when a sale happens, but the goods don't move at all. And third, when goods are delivered and then have to be assembled at the customer's location. Let's take a look at the most common one, supplies that involve movement. Here, the rule is super simple. The place of supply is just where that movement ends for delivery. For instance, if a company in Nasik, Maharashtra, sells and ships a refrigerator to a buyer in Pune, also in Maharashtra, the journey ends in Pune. So the place of supply is Pune. Simple. Okay, but what about a situation where the goods don't move at all? A sale made as is, where is. Imagine a company in Noida is leasing a big machine in its factory and then decides to just buy it outright. The machine is already there, it's not going anywhere. In that case, the place of supply is simply its location at the moment of the sale, which is Noida. And finally, what if you sell something that needs to be assembled on site? Let's say you buy a machine from a supplier in New Delhi, but it has to be installed at your factory in Noida. The place of supply isn't Delhi, it's the place of installation, which is Noida. So the tax revenue for that sale belongs to Uttar Pradesh.
So that pretty much covers physical goods. They're logical, you can follow the item, but things get a bit more abstract when we talk about services. I mean, how do you find the destination or place of consumption for a product that's completely invisible?
Well, the law starts with what it calls a general rule to cover most services. For B2B transactions, that is, sales to another registered business, the place of supply is simply the location of the recipient. Nice and easy. For B2C transactions, so sales to a regular consumer, it's also the recipient's location, but only if you have their address on record. If you don't, it defaults back to the location of you, the service provider. But, and this is a big but, lots of common services have their own specific rules that actually override that general one. For a hotel stay, the location is the hotel itself. For a restaurant meal, it's where you ate. For a B2C flight ticket, it's where you board the plane. And for your mobile bill, it's your billing address. You see, each rule tries to find the most logical way to figure out where that service was consumed.
Let's make this super clear with an example. A business traveler from Delhi stays in a hotel in Mumbai. Since a hotel stay is a service directly related to an immovable property, the hotel building, the place of supply is the location of that property. In this case, it's Mumbai, so the GST revenue goes to Maharashtra.
Okay, one more. An unregistered person from Gurugram takes a flight from New Delhi to Mumbai. The rule for B2C passenger travel says the place of supply is where the passenger embarks on the conveyance. That's just a fancy way of saying where you get on the plane. So the place of supply is New Delhi.
Okay, we've broken down the rules for goods, and we've navigated the tricky world of services. Now, let's connect all the dots and see how this determines the final tax you actually have to pay.
This little table here shows how simple the final logic is once you have the two key addresses. Look at the first row. A supplier in Punjab sells to a place of supply that is also in Punjab, same state. That's intrastate, so they charge CGST and SGST. Now compare that to the second row. A supplier in Punjab sells to a place of supply in Haryana, different states. That's an intrastate supply, so they charge IGST. See?
So the main takeaway, the one thing to remember from this entire explainer can be boiled down to one simple formula. Your location of supplier, combined with the correct place of supply, directly tells you what type of tax to charge. Get these two locations right, and you get the tax right.
And this brings us to a final, forward-looking question. In an age of digital services, streaming, and cloud computing, the concept of a physical destination is getting, well, blurry. So how are we going to define the place of supply for service that's consumed everywhere, all at once? That's the challenge that will redefine tax law for the digital economy.